Hello and welcome back to Money Mastermind. Today we are exploring a simple investing hack and how it can make you millions. Now let's get started. But first, if you enjoy this content or anything related to investing, be sure to like and subscribe for more videos like this. Now let's get straight into it. Compound interest, a term often associated with financial success, is key to unlocking wealth over time. At its core, compound interest refers to the process where interest is not only earned on the initial investment, but also on the accumulated interest over time. This compounding effect can significantly accelerate wealth accumulation, making it a fundamental concept in the world of personal finance. Understanding compound interest is crucial for individuals aiming to achieve their financial goals. By understanding how it works and exploiting its power, you can make informed decisions regarding your saving and investing strategies. Whether it's planning for retirement, saving for a child's education, or simply growing one's wealth, compound interest plays a vital role in shaping financial outcomes. In this video, we will explore compound interest. First, we will provide a comprehensive definition of compound interest and explain its fundamental principles. Next, we will examine the importance of understanding compound interest, emphasizing its impact on long-term financial planning and wealth accumulation. Finally, we will provide a preview of the topics that will be covered in subsequent sections, including the magic of compounding, strategies to maximize compound interest, and overcoming common obstacles in using this powerful financial tool. By the end of this video, you will gain a newfound appreciation for the transformative potential of compound interest and be equipped with practical insights to use its power in your own financial journey. Compound interest is a financial concept that plays a pivotal role in wealth accumulation and investment growth. At its core, compound interest refers to the process where interest is calculated not only on the initial principal amount, but also on the accumulated interest from previous periods. This compounding effect results in exponential growth of an investment over time. Unlike simple interest, which is calculated solely based on the initial principal amount, compound interest takes into account both the principal and the accrued interest. This means that over time, the interest earned on an investment grows progressively larger as the interest itself earns interest. To illustrate the difference between compound interest and simple interest, consider the following example. Suppose you invest $1,000 at an annual interest rate of 5%. With simple interest, you would earn $1.50 in interest each year. However, with compound interest, the interest earned in the first year is added to the principal for the second year's calculation. So in the second year, you would earn interest not only on the initial $1,000, but also on the $1.50 interest earned in the first year. This compounding effect continues to grow over time, resulting in significantly higher returns compared to simple interest. In essence, compound interest uses the power of time and reinvestment to accelerate wealth accumulation, making it a valuable concept for investors seeking long-term financial growth. Understanding the mechanics of compound interest is essential for making informed investment decisions and maximizing the potential returns on investments. Compound interest possesses a unique and powerful characteristic often referred to as the snowball effect. This effect occurs when the interest earned on an investment is reinvested, leading to exponential growth over time. As the investment grows, so does the amount of interest earned, creating a compounding effect that accelerates wealth accumulation. Visual representations of compounding over time vividly illustrate the remarkable growth potential in this concept. Graphs and charts showcasing the exponential increase in wealth resulting from compounding can be compelling motivators for you to start investing early and consistently. Real-life examples further highlight the transformative impact of compounding on financial outcomes. Consider two individuals, Sarah and John, who both invest $10,000 in the stock market. Sarah starts investing at age 25 and contributes $100 per month, while John begins at age 35 and contributes $200 per month. Assuming an average annual return of 7% by the time they reach age 65, Sarah will earn on average $80,000 more than John. This contrast highlights the significance of starting early and the power of compounding. Compounding not only increases investment returns, but also provides a pathway to financial independence and security. By understanding and leveraging the magic of compounding, you can set yourself on a trajectory toward achieving your long-term financial goals and enjoying a prosperous future. Time plays a crucial role in the magic of compounding. The earlier you start investing, the longer your investments have to grow and compound. This means that even small contributions made early on can result in substantial wealth accumulation over time. Time allows investments to withstand market changes and benefit from the compounding effect, ultimately leading to greater financial security and freedom in the future. To highlight the importance of starting early, let's compare two scenarios: early investing versus late investing. In the early investing scenario, an individual begins investing in their 20s, consistently contributing to their investment portfolio over several decades. In contrast, in the late investing scenario, an individual delays investing until their 40s or later, missing out on the crucial early years of compounding. The impact of starting age on wealth accumulation is profound. By starting early, you have the advantage of time, allowing your investments to grow exponentially. Even with smaller initial contributions, the compounding effect can significantly boost the value of your investment portfolio over the long term. Conversely, delaying investing can result in missed opportunities and a smaller nest egg by the time retirement age approaches. Starting age plays a critical role in determining the ultimate success of your investment strategy and ability to achieve financial goals. Consistent investing, often referred to as paying yourself first, is a fundamental strategy to maximize compound interest. By prioritizing regular contributions to investment accounts, you ensure that you are consistently putting your money to work and benefiting from the compounding effect over time. Setting up automatic transfers from a paycheck or bank account to an investment account can help maintain this consistency, making it easier to stay on track with long-term financial goals. Leveraging tax-advantaged accounts is another effective strategy to optimize compound interest. Accounts such as IRAs and 401ks offer tax advantages that can improve investment growth. Contributions to these accounts are often tax-deductible, and investment gains accumulate tax-deferred or even tax-free in the case of Roth accounts. By taking advantage of these tax benefits, you can maximize your returns and accelerate wealth accumulation through compound interest. Reinvesting dividends and interest are a proactive approach to using the full potential of compound interest. Instead of withdrawing dividends and interest earned from investments, reinvesting them back into the portfolio allows for continuous growth and compounding. Over time, these reinvested earnings can significantly boost the overall value of the investment portfolio, amplifying the compounding effect and accelerating wealth accumulation. By implementing these strategies, you can optimize the power of compound interest to achieve your financial objectives efficiently. Consistent investing, leveraging tax-advantaged accounts, and reinvesting dividends and interest serve as pillars for building a strong foundation for long-term financial success. Compound interest plays a crucial role in retirement planning by helping you build a substantial nest egg for your golden years. Through consistent contributions to retirement accounts, the compounded returns can significantly grow retirement savings over time. By starting early and allowing investments to compound, you can ensure you have sufficient funds to support your desired lifestyle during retirement. Saving for education expenses is another area where compound interest can make a significant impact. By investing in education savings accounts like 529 plans, parents can take advantage of compounding to grow their college savings over the years. Starting early and regularly contributing to these accounts can help alleviate the financial burden of higher education expenses when the time comes for their children to attend college. Achieving long-term financial freedom is the ultimate goal for many individuals, and compound interest is a powerful tool to help make this a reality. By consistently investing in a diversified portfolio and allowing returns to compound over time, you can gradually build wealth and work towards financial independence. Whether it's retiring early, pursuing passions without financial limitations, or leaving a legacy for future generations, compound interest empowers individuals to achieve your long-term financial aspirations. In summary, compound interest serves as a cornerstone for achieving various financial goals, including retirement planning, saving for education expenses, and attaining long-term financial freedom. By understanding the principles of compounding and implementing strategies to maximize its benefits, you can pave the way toward a secure and prosperous financial future. Lack of financial literacy presents a significant barrier for many individuals looking to exploit the power of compound interest. Without a solid understanding of financial concepts, such as investing, budgeting, and managing debt, you may struggle to make informed decisions about your finances. Overcoming this obstacle requires a commitment to financial education, whether through self-study, workshops, or seeking guidance from financial professionals. By improving financial literacy, you gain the knowledge and confidence needed to navigate the complexities of investing and maximize the benefits of compound interest. Impatience and short-term thinking can hinder long-term investing success. In today's fast-paced world, many individuals seek instant gratification and may be tempted to chase quick returns or make impulsive investment decisions. However, successful investing requires patience and discipline to stay the course, especially during market changes. Overcoming the urge for instant results involves adopting a long-term perspective and focusing on the benefits of compounding over time. By setting realistic expectations and staying committed to your investment strategy, you can avoid surrendering to short-term thinking and enjoy the rewards of compound interest in the long run. Strategies for staying committed to long-term investing include setting clear financial goals, establishing a diversified investment portfolio, and automating contributions to investment accounts. Also, regularly reviewing and adjusting investment strategies as needed can help you stay on track towards your objectives. Surrounding yourself with a supportive network of peers or seeking guidance from financial advisors can also provide encouragement and accountability in staying committed to long-term investing goals. By implementing these strategies and staying disciplined in their approach, you can overcome common obstacles and unlock the full potential of compound interest for your financial future. Compound interest stands as an impressive force in the world of personal finance, offering a pathway to wealth accumulation and financial security. Throughout this video, we've explored the transformative power of compound interest, witnessing how consistent investing and the compounding effect can turn small contributions into significant wealth over time. By allowing investments to grow and reinvesting earnings, you unlock the full potential of compound interest to achieve your financial goals. Starting early is crucial when it comes to maximizing the benefits of compound interest. By beginning the journey of investing sooner rather than later, you leverage the power of time to your advantage and set yourself on a trajectory towards financial independence. Encouragement to start investing early serves as a rallying call for you to take action today and lay the groundwork for a prosperous financial future. In closing, compound interest plays an indispensable role in achieving financial success and realizing long-term goals. Whether it's planning for retirement, saving for education, or pursuing financial freedom, compound interest serves as a reliable ally on the journey towards financial well-being. By embracing the principles of compound interest, staying committed to long-term investing, and continuously seeking opportunities to grow wealth, you unlock the door to a brighter financial future filled with possibilities and opportunities. Remember, the journey to financial success begins with a single step. Start investing early and let compound interest work its magic for you. Thanks for watching Money Mastermind. If you enjoyed this video, be sure to check out our other videos for more investing tips. Don't forget to like and subscribe to stay updated on all our latest videos, and we'll see you in the next one.